how to make sense out of chaos. And with this training is specifically for beginner traders who are learning how to trade and maybe already started. I see a lot of new people entering the market, especially now with the COVID-19 and people losing jobs and trying to make extra income, which is logical, of course. And just, trying to get out there, making trades and trying to get a comprehensive knowledge of everything that I see in books, but also online, there is a lot of information. So probably if you are one of them, this is how you feel, right? There's a lot of information coming onto you and you're wondering, how am I even going to take a trade, considering that there is so much to learn? Like, how do I find the right stocks? What do I look at when I'm looking at the chart? How does it even work? How do people execute trades? When do they get in? When do they get out? How do they make money in trading? And how is it possible that they can actually make thousands of dollars every single day? When you start learning trading, a typical trader is trying to learn everything there is about trading. Everything about the market, all kinds of parameters, and there's a lot. There's really a lot to learn. All the little, pieces of information. This is the way how we normally try to learn. We just gather the knowledge and trying to make sense out of it. And with trading, it's not different. And why is it so that everyone is trying to learn the same way? It's because that's how most of the trading courses are set up. So this is just normal that when you start, you think this is the way it works. They give you all the knowledge, and what you're trying to do is to make sense out of it and connect the dots yourself. So you will hear from the very beginning, they will be talking about your go-to setup, about finding your niche, that you have to do it in order to be successful. However, you're not really sure, first of all, what it means for you. And also, everyone is telling you, you will find out eventually. It just will take experience and practice and time. They don't really tell you probably that it will take also a lot of money that you might be losing during practicing and trying to find out what works and what doesn't. So you'll be trying many things out. And because you don't really know what will work for you, you will be using your time and experience. And at some point, you will start seeing a certain pattern popping up that will work for you. Certain setups that might work better for you than others. You might not understand exactly why is it working better for you, but you will start feeling a little bit more comfortable with them and start testing them even more because they will be giving you better results. And eventually, if you are still in the market and if you still have the capital to trade, you will find your go-to setup and then filter all the other information out while wondering why the hell did you just went through all this trouble. So from then on, you will have your go-to strategy that will be your cash cow, and you will develop a sort of intuition as you will. So if you focus on that one strategy that perfectly suits you, you will have an additional edge in trading, right? You will get much deeper knowledge because you'll be focusing on one thing. So you will have much bigger knowledge and deeper knowledge and experience. And with experience, you can develop something like intuition. You probably recognized it from just the everyday life, that when you doing things over and over again and you learn more about them, at some point you don't really have to actively think about it. You just get that gut feeling, you know that it's right? So intuition is really nothing more than the deep knowledge and experience combined. It is engraved in the structure of your brain, and then you can apply it without active thinking. It is engraved so deeply that influences your feelings as well. And, you know, active thinking and your feelings, your emotions are the biggest source of mistakes in trading. So the more you can exclude it from the trading process, the better trader you will become. You know that if you know when you feel something is not correct, right? So you also feel when something does work. That's that intuition feeling, and that's just because you have seen the same situation over and over again 1,000 times before, and now the brain is subconsciously sending you that signal. That is so important for you as a trader, that instead of wasting your time to try to learn everything, you focus on that one strategy, maybe 2, maximum 3 setups, and then spend hours practicing it and repeating that one thing so that you really engrave it into your brain. And you know, the brain is basically trained in building the neurological connections. So that is what will then make you handle the situation perfectly. When you see the pattern showing up on your screen, you will just automatically know how to take the trade and make the profit. So that's basically the process that you are going through, or most typical trader is going through when learning trading. Now you're here, and then you want to be on the other side of that whole process. So what is all this information when you begin? What are the information that you have to learn, and how can you make sense easily out of it? Let's look at the elements that you need to learn, the basic elements that you need to learn to trade. There are basically 7 that you are probably most likely already trying to learn. And there is also, of course, like a general knowledge of the market and economy, but I'm not going to talk about that because I assume that if you are planning to trade stocks, that you have a general interest in economic developments and politics and how the market works. So I assume that you keep yourself informed on a daily basis. So let's go one by one of those 7 basic elements. Your trading strategy. The first thing that you need to do is to define your strategy. And we just talked about it, why it is so important. Difference between a strategy and a setup, there are 2 different things. Setup is a part of your strategy, as you see here as a last element. So strategy are all these elements that you see here. So the type of stocks that you are going to trade. So for example, what sector are you going to trade? Are you thinking about trading retail stocks or commodities or currencies maybe? And then also what price level stocks you will be trading. That is, of course, connected to your capital as well, how much money you have on your account. And you are able to trade. Some people trade penny stocks, which are very cheap stocks under $1. And some people trade stocks like Tesla, which just hit $1,000 per share. Then you have the direction. Are you a bull or a bear? So are you gonna long the stocks? Are you more bullish or are you more bearish? And are you gonna trade both directions? We'll talk about it a little bit more in a second. Time frame. So are you gonna be a day trader, or you will be holding the stocks for more than 1 day and then you will be swinging it? That also depends on your lifestyle, of course, and on your targets. Your trading target. So that is part of your strategy definition. What is your position size? Based on your capital and your risk levels, how many shares per trade will you be buying? What will be your starting position? What will be your full position? those things you need to define before you even touch the mouse and place an order. Your risk level, that's like one of the most important part of your trading strategy, because when you are looking at the profit, it really is important to see how much money are you willing to risk in order to take the trade. If you don't have a defined risk level, then you're basically gambling, and you are most likely going to lose your trading account. Then your profit and loss taking strategy. So it's not only about profit. If you are risking money, that means that you have to accept that you can lose it too, but you can never allow yourself to lose more than you are making, because otherwise, what's the point of trading, right? And then we have the trading setup, and we will talk about those a little more in a second. So these are the trading setups. These are like the most popular trading setups. You see that there is a lot, right? And probably when you are trying to learn all of them, you're like, how can I even focus? Like, which one am I choosing? Am I just trying to learn them all? How am I going to do that? So even though this looks very overwhelming, I would say, at least it was for me when I was learning, there are just really three major groups of setups. There are breakouts, there are breakdowns, and there are pullbacks. The difference is between those three groups is that in order to trade breakouts, you have to think bullish. You have to bet that the stock will go up. So then if you are on that side in your strategy, then you will be looking into your bullish setups. If you are more bearish and bet on the stock going down, you'll be looking at the breakdowns, because that's the direction the stock goes. Whether you can actually short the stock, which we call shorting a stock, is the stock, making money on the stock that goes down. So usually when you are bullish, and you are in a position the stock goes down, you're losing. But if you're bearish and you short the stock, you're actually making money when the stock goes down. And there are setups that are specific for those for this strategy. And then you have pullbacks. So you can trade both direction. You can have pullbacks for bears and pullbacks for bulls. So if the stock goes up and then it does pull back, because what goes up must go down, right? So there are no straight lines. Well, sometimes there are, but eventually they will pull back. And if you trade those setups that are within the pullback group, then you can do it from both sides, because whether the stock goes up or down, it will always pull back. And then there are specific setups that you can choose. And then there are other setups that are like more classical, and those patterns you can always kind of qualify it into those three categories. The importance of trading setups is that when you are looking what to trade, it makes it easier for you to actually qualify whether some stock is something you want to look at, because then you know whether it fits within your trading strategy. The next one is finding the right stock to trade. So how do you do that? It basically depends on your strategy and your setup, as I said. So you first need to use your scanning platform. What scanning platform? And this, you can do this straight away. You can basically look at in the market and see what scanning platforms there are. You can see whether you want to use an external scanning platform outside of your brokerage account, because the scanning platforms might have better charts, so it's easier for you to see, and they also have much easier way to scan for stocks. The parameters are easier to fill in. But if you know your strategy, then you know what parameters you actually looking for, because if you're looking for breakouts, that defines very quickly what stocks you're looking for. Then once you know what you are looking for and you did your scan, then you prepare your watch list. You literally put those tickers with, the symbol of the stock, it's called a ticker, and it always has a $sign up front. Then you put it on your list, your watch list. You can enter into your trading platform and just watch throughout the day. You can make your strategy around it. So not only put a ticker on, but also define the level where you see, okay, according to my setup, this is the level where I should be entering the trade. This is the level where I should be exiting it. And what is your risk level? If you want, you can even put those trades into your platform and pre-program it, as you will basically enter your trades up front and just let it go. That also depends whether this will be your strategy and whether you want to sit in front of the platform and control your trades yourself, or you want to do, if you say, let's say you have a full-time job and you cannot watch the stock market the whole day, but you still can make trades once you have defined your risk level and you put your stop order into the platform. So you can also set your alerts in your trading platform based on your scanner and always refine it. So if after one day the stock moves and your setup changes a little bit and you say, okay, I was thinking that it's gonna break out certain stock and it didn't, you can always adjust it and see, maybe I can move my price a little bit, or maybe your setup is not going to work at all because the stock did something that you totally didn't expect and you don't like it anymore. Next thing is charting. So you have to decide on your charting platform. And even though maybe it sounds a little silly, you have to choose how your charts will look like. It is not about charts being pretty, but it is about you being comfortable with what you see on the screen, because you will be staring at those charts the whole day long. And it has to be pleasant for your eyes, and it has to be clear to you what you are looking at. So there are different colors. There are like dark and a light mode. Some people like, it's easier for the eye to look at the black chart, and some people prefer to have it cleaner and have it white background. It is really important that you will try both and see what works better for you. You can do that even before you start trading, because this is a pure visual and personal preference thing rather than rocket science or good or bad. So you can also define your arrangement. So if you have multiple screens, or even if you have one screen, you can define how will you be looking at the charts. Will you have multiple charts open with multiple timelines on your screen? Or maybe you just want to watch 2 or 3 stocks and not 10, because at the beginning, it is not really easy to concentrate. And I'm saying at the beginning, but I still, after so many years of trading, I do not watch more than 5 stocks at a time. I know. If you look online, there are people with the whole wall around them with charts. Maybe that's what works for them. It does not work for me. What works for me is to watch the stock, just a few of them that I am focused on during one particular trading session, and almost learn it by heart, the moves, how the stock behaves, what are the price levels, so that when I see it, I almost like make a personal relation with the ticker, so that I know and I feel I can trust it. I know how it moves. It doesn't mean that I assume what it's going to do, but I do recognize the levels, and it takes away one more thinking process that takes place in my head during trading. Another thing is also different indicators that you are going to put on your charts. You probably have been reading, if you started learning about the indicators in technical analysis and how important they are and how many there are, and everyone is using something else. We will talk about those indicators in a second, more in details, but remember that those indicators will be on your charts, and you need to know and recognize what they are. They can have different colors, they can have different lines, whether it's dotted line or solid line. That is also your personal preference, and the best way to see what works for you is just to put it on your charts and watch the stock move and see how they work for you. Then let's talk about trade execution. For trade executions, you will need a brokerage account, right? So there are different brokerage accounts, and what I recommend you to do, if you haven't opened one yet, try different ones. The brokerage accounts, they have a paper trading version, which is trading basically with fake money. So you don't need to fund the accounts in order to try the platform, or they have trial versions. This is really important that you are comfortable with the platform and that it is quick and easy order execution and order entering, so that you don't waste time on trying to figure out how to place an order. Some of the trading platforms also have charts. So you might want to have just one combined, or using two different ones, one for trading and one for charting. For trade execution, it is also crucial that you will define what type of orders you will be using. You probably have heard of limit orders and market orders. There are different type of orders, and it is important that you find out for yourself, like what is the difference and what would be your preference. Also depending on your strategy, I usually actually always use limit orders and stop orders, and sometimes stop limit orders. Pretty much that's my range. I feel comfortable with that. I never feel comfortable with using the market order, because I rather know what the price I'm buying for, and I want to decide my price. If I miss my price and the stock goes without me, that's the way it is. I accept it, because in my strategy, I want to buy the stock for the price that I decide that I want to buy the stock. The last but not least element of order placement is your stop price. It's not so much the stop price, but whether you'll be using stop and profit taking orders, that you be using hard orders, meaning like putting them into the system, or your mental stops, which means you know what your risk is and you know when you should get out, but you will do it once the stock get there. It really depends. The recommendation is to always at the beginning use hard stops, because it is not easy for a beginner trader to get out with a loss and to accept it if you don't have a fix like the hard stop order. But it really depends on your trading strategy and also on the market volatility, because if the market is very volatile and you put your hard stop, you might be stopped out many times within the same trade, while the stock is just very choppy. But that's something that you need to define in your strategy, how you want to do it. The next one are technical indicators. So technical indicators, there are basically calculations that are based on the historic price volume or open interest information, and they aim to forecast financial market direction. That's the definition of it. But if you break it down and make it simple, it's basically what analysts are using to see what the past trends were, and they anticipate their future moves. That's not something that helps you to see into the future, but it is something that analysts do use to anticipate the future. There is nothing certain in trading, so everything is, basically a theory. And you can group them. There are 12 most commonly used technical indicators. And to make things simple, you can basically group them into just a few categories. So there are leading indicators and there are lagging indicators. The leading ones are the ones that they change the direction before the actual price of the stock does change the direction. Those indicators, they look forward and they aim to signal the change before it actually develops. The example of leading indicator is the RSI. You might have heard of it. It's the relative strength index, or the stochastic oscillator, and also OBV, which is the unbalanced volume. These are just a few of the examples. And then we have the lagging indicators, and those are confirming the trends that have already taken place, or that they are already taking place. Those are far slower to react, which means that the trader would have more accuracy, but could be late in entering the market. The lagging indicators, they basically alert the traders to situations that trends have started, and it is now time to pay attention to developments that have already become apparent. And the examples are simple moving averages and exponential moving averages. Type of indicators that you would be using will again depend on your strategy. Within the lagging and leading indicators, there are 4 types. There are trend indicators, momentum indicators, the volatility indicators, and the volume indicators. And how do you choose the ones that you are actually using? So for the day trader, it is important that you will choose one trend indicator, such as, for example, moving average, because it shows you long and short-term trend direction. Then choose one indicator that shows you the momentum. For example, RSI. It will show you whether there is a momentum, or it will show you whether there is lack of. And always look at the volume. The volume is crucial in order to have liquidity, and also to see if there is interest in the market. If you want more information on indicators and have a really nice, I found online, and the source is let me see at the beginning. So here you see the domain that I put on the slide here. It's very nice website that they have several infographics, and one of them is about the indicators. One of them is also about the market lingo. I'll tell you in a second. Just check it out, because it's very simply grouped by lagging and leading, and then it shows you different type and exactly explains what they all means. At the beginning, do not try to use them all. Look at your strategy and make sure that the indicators that you are choosing fit your strategy, that they support your strategy. Because if you are a trader, if your strategy is to trade pullbacks or to trade reversals, then you really need to know upfront when the trend is changing, when you will look at the indicators that are confirming the trade, you'll be too late to the game with your entry. The next thing is journaling. And I know that a lot of people think this is not very important when they start because they all about making money. But if you keep your trade log, your learning curve will significantly be shorter because you will know where you're making mistakes and you will be able to learn much quicker. Here are some items, or some, this is actually pretty complete list of items that you should have in your trade log and keep every day when you are trading, even when you are paper trading. Have a reason to enter. If you are seeing a trade, if you're seeing a setup on the chart forming and you are planning to make a trade, you have to know why you're entering. You cannot just say, oh, it just looks great, or I think it will go up. You have to have a reason to enter the trade. Otherwise, you're risking money for, it's a gamble because you don't really know what you are looking at. So give yourself the chance to win and have a reason to enter the trade. Write down what your price trigger is. That is something that basically you could take from your watch list, because on your watch list, you will say, okay, if that setup, if that stocks will hit this price, this is where is my trigger to say my setup is working. Then you have the entry price. The trigger is not your entry price. The trigger is your price where you say, this is where it's getting serious. This is the level where I really have to watch now. What is the stock doing? Then you have your stop price. So what is your risk level? You define that in your trade log. What was your stop price? And what is your target price? When are you planning to take profit? So if you have it defined before, you have to know what the estimated gain is, so that your estimated risk reward ratio is not smaller than 2-1. You want to make sure that if you risk the money, you have the opportunity to make twice as much. This is your estimate, right? This is how you are planning your trade. You will see that many times when you put your exit price, it is not always the same as what you thought you will gain. And that might be because the market condition changed, or it might be that you just didn't have a patience to wait and you got excited about seeing that you have some profit and you just got out. It might be that the stock went and still hit your target, but you got out earlier. So write it down, because you will see that this will give you a certain amount of confidence if you see that even if you will get out earlier, but your estimates were right and the stock went higher, which you can put in your notes in your trade log. It will give you a confidence that you are looking at the right things. And also the reason for exit. If you are exiting on target, that's a great reason. If you are exiting before, write down what the reason was. Did you get scared? Did the direction of the trends change? Or maybe there was some news on the television and suddenly the S&P index started tanking, and you thought, I'm getting out because it looks like this is not going anywhere. And then you write your actual profit or loss if you lost money, and your actual risk reward. This is a format that will help you to refine your trades and grow as a trader. Then we have candlesticks, types, and patterns. I'm sure that when you look at the chart, you see a lot of different candlesticks and then a lot of movement, and you think, how am I even going to see that pattern? And maybe some of you already recognize it, which is great. There's definitely plenty to learn, but what you really need to know at the beginning is just the basics. What you really need to know is, how does this candle gets formed, right? You might know by now that one side of the candle is the opening price, one side is the closing, and then the wick of the candle is the movement in between. The candle is basically the price action, the move that it's taking, the movement that is, that those transactions between buyers and sellers. If you look at the candle from that perspective, it will give you already an idea, where is this going? Like if the price action is really strong and the candle goes up and up and up and closes higher, you probably be thinking, wow, there's a lot of buyers and they bid the price up. Most likely this is a strong candle, this stock is going to move up. But if that's how basically those patterns are being formed. It's behind those patterns is the price action. You don't need to learn all of them. This will come as you go, but it is important that you will know those candle types that are relevant for your particular setup. So for example, if you play reversals, what you need to know is, right, if you play a reversal, you're basically looking for a trend change in the movement. You need to know which candle type or which candle pattern is pointing to the reversal. So you don't need to know like all of them, but those key ones that are very key to your particular setup, your strategy, are really important. And online, there is a lot of infographics like the one that I posted in here. And, you can get crazy with those. And if you want to learn all of them, but that really depends on how crazy you want to make it for yourself. And the last but not least is the market lingo. There is the infographic that I mentioned on stocktrade.com that has approximately, I think it has 40 basic terms of the language, of the market lingo that you can take a look. You can probably even print it out and just see what is what. But what is really important is just don't stress over it. When you're getting into the market, you will learn the lingo by itself. I mean, the most important thing is that you know the basic trading terms, or something that is really relevant to everyday trading, and the rest will come. It's not like you have to know it immediately. What is more important though, in terms of language, is keep your trading language clean. And what I mean with that is there's a lot of talk from like gaming talk within trading. We talk about plays, we talk about winning, we talk about losing. But on a subconscious level, those things have to do with gambling. And what you need to remember is that trading is business and not a game. When you are playing, you actually, or winning, you actually making money. And the way you give it back to yourself, even if it is just in your head, it is really important, because you're not a player and you're not a loser when you are losing money. Every loss is a lesson. And if you feel as a loser, that is a recipe for disaster as a trader, because you will be losing your confidence as well. So a lot of information, right? Where to start? You can basically group all this information based on your strategy to those three categories: the must-haves, the good to have, and nice to have. You probably do it already in your daily life. We see it a lot of in organizations or in budget planning. This strategy is actually really very simple, but it's very effective. So once you have your strategy, you will know what you will have to define what are those must-haves and what is not. So how do you do that? You choose the strategy first, so then you can categorize the information that is relevant to you. Don't try to learn everything at once, as I mentioned. You will learn the things along the way anyway, and then they will make much more sense to you because you will be able to put them in context than just learning it from the books. When you learn about technical indicators and candlesticks, choose the ones that support your strategy. Let's say you are someone who is a trendsetter. Let's say you're someone who is a trend follower, right? So you will be looking into the indicators that are pointing to a trend and following the trend. When you have to be aware of, what you have to be aware of is what is the signal that the trend is changing. Those things are the must-haves. You need to know your stuff, let's say, that are relevant to your strategy. What you see is it really all starts with strategy and a setup that you want to trade. If you define that first, the rest comes by itself. And while you're mastering that one strategy, the maximum 2 or 3 setups, not more, you will be able to start making money right away while you can learn the rest. Because in trading, you really never, ever stop learning. There is a lot. So having that one go-to strategy is really crucial to your success as a trader. And the sooner, the better, because the sooner you start mastering that one thing you focus on, the sooner you will develop the intuition and you will be able to take away that variable element out of trading that is you, a human being with emotion and overthinking capabilities. You are trying to develop yourself as a trader, right? And if you look at the origin of the word to develop, it actually indicates that the process of development is making things simpler. It means to unfold, to undo, and to simplify, going back to basics. If after all you saw today, you still ask yourself, how do I make sense out of chaos? The answer to your question is very simple. Keep it simple. Keep it as simple as possible. Focus on what really matters and what matters to your strategy. So uncover your true strength. What are you good at as a person? And then focus your efforts on building around it and building your strategy based on your strengths. Keeping it simple, it will decrease the frustration and also the paralysis by analysis thing when you are in the middle of all this information. It will give you confidence and it will help you achieve success. I wish you a wonderful weekend and see you next time. Bye for now.